Hello everyone, today we're going to be covering the topic of restructuring in bankruptcy for public companies. And this is part of the Chapter 11 in the book M&A and Corporate Restructurings by Patrick A. Gaughan. I've provided a link in the video description where you can check out the textbook if you're interested in buying it. But this is a very important chapter, especially for more advanced students who are interested in entering the M&A space and really understanding how in some businesses when they begin to really struggle and almost fail, you have to understand the options available. The options are not just, if we go into bankruptcy, that's it. No, there's the potential to restructure in bankruptcy, and the options available are numerous. So it's important to understand those options. So let's get started. So a quick video overview. The two main sections of the U.S. Bankruptcy Code that we're going to be covering are Chapter 7, Bankruptcy, and Chapter 11. There's also Chapter 9 bankruptcy, which is more the municipal bond area, but that's not going to be covered in the video. And within Chapter 11, we're going to be spending much more time on Chapter 11. We're going to be covering the court proceedings, the prepackaged bankruptcy options, and the workout options available, and also looking at the shareholder wealth effects as well. So it's quite a lengthy video, but it's very helpful for those students who are interested in getting involved in the M&A space. So let's get started. Bankruptcy can be a creative corporate finance tool. Reorganization through the bankruptcy process can, in certain instances, provide unique benefits that are unattainable through other means. Clearly, bankruptcy is a drastic step that is only pursued when other, more favorable options are unavailable. A bankruptcy filing is an admission that a company has in some way failed to achieve certain goals. The Bankruptcy Act of 1978, the Bankruptcy Code, is the main bankruptcy law of the United States. It organized bankruptcy laws under 8 odd-number chapters, chapters 1 through 15, right? And so the most common ones that you hear about are Chapter 7, 9, and 11. 11 is very important, and from a personal perspective, Chapter 13, that's bankruptcy for individuals. But what's relevant to us is Chapter 7 and Chapter 11. So this is quite interesting, and it's a very lengthy document, very important for people entering that side of the business. So there are two main forms of business failure. There's economic failure, and then there's financial failure. Economic failure is more ambiguous. For example, economic failure could mean that the firm is generating losses, that is, revenues are less than costs. However, depending on the users and the context, economic failure could also mean that the rate of return on investments is less than the cost of capital. It would also mean that the actual returns earned by a firm are less than those that were forecast. Financial failure is less ambiguous than economic failure. Financial failure means that a company cannot meet its current obligations as they come due. The company does not have sufficient liquidity to satisfy its current liabilities. So majority of the time when companies head into bankruptcy, they're facing financial failure. They're unable to cover their obligations. But there are some certain instances where companies realize that it is much more effective to pursue bankruptcy in order to restructure the business because they're suffering from an economic failure. But it's more common financial. Now, researchers have found that the 3 most common factors in order of frequency were economic factors, such as weakness in the industry, financial factors, such as inefficient capitalization, and weaknesses in managerial experience, such as inefficient managerial knowledge. So when looking at the study, and researchers found that from a percentage perspective, the underlying causes of bankruptcy during this time in corporate America, 41% of the time, it was economic factors such as industry weakness or insufficient profits, financial failure, right? There was financial factors such as heavy operating expenses and inefficient capital, which is deployed whether through bad M&A or there's just a change and really the overall quality of assets, which really impacted the business. And so that was about 32.5% of the time. And then there was also experience factors. So there's a lack of business knowledge, lack of line experience, or lack of managerial experience. And this is usually when a new management team comes in to lead that company, and they don't really understand the company properly. They make poor decisions, which destroy shareholder value and eventually drive that company towards bankruptcy. And that was about 20.6% of the time. Okay. In addition, they analyzed the average ages of the business that failed. they found that only 10.7% of the failures were in businesses for 1 year or less. Just under 1/3 of the companies were in business for 3 years or less, whereas 44.3% existed for up to 5 years. And I think this is really important to understand. When you think of, bankruptcy, it's a small business, it's young, they don't really know, and they're making all these mistakes, and that's why they're destroying shareholder value. But really, in the first 2 years, only 20.8% of businesses actually head into bankruptcy. Whereas if you go 5 years and more than 10 years, really the older businesses that are seeing changes in leadership, changes in strategic decisions that are impacting really the foundation of the business, that's where really problems occur. And that's why when you think of causes of business failure, it's due to core changes rather than just what you initially built the business on. Usually businesses that are initially built, you build them on a strong foundation, something that you're confident in for the medium term. But over the medium term, as you're preparing the business for the long term, that's where you need to make sure that you're making the correct decisions. Now, financial distress and bankruptcy have been linked to many of the highly leveraged deals that took place in the 1980s. Dennis and Dennis conducted a study of 29 leveraged recapitalizations that took place between 1984 and 1988. They define leveraged recapitalizations as transactions that use proceeds from new debt obligations to make a payout to shareholders. Their results show that 31% of the firms that completed leveraged recapitalizations encountered financial distress. And so this is important from a private equity perspective. For anyone who's interested in the private equity space, one of the ways to monetize the existing holding of a private equity firm is to pay out a large dividend. You take out debt using the business, and it's again collateral, if it's the assets for collateral, and then you pay a massive dividend to the equity owners. Well, the study has shown that during the 1980s, when private equity investors were doing this, over 31% of firms actually went into bankruptcy after they conducted a leverage recapitalization, right? So it is a risky proposition, and that's why other exit opportunities are much more favorable. Now, Chapter 11. The reorganization. The purpose of the reorganization section, Chapter 11 of the Bankruptcy Code, is to allow a reorganization plan to be developed that will allow the company to continue to operate. This plan will contain the changes in the company that its designers believe are necessary to convert it to a profitable entity. If a plan to allow the profitable operation of the business cannot be formulated, the company may have to be liquidated, with its assets sold and the proceeds used to satisfy the company's liabilities. The reorganization process starts with the filing of a bankruptcy petition for relief with the bankruptcy court. In the petition, the debtor lists its creditors and security holders. Standard financial statements, including an income statement and balance sheet, are also included. The court then sets a date when the creditors may file their proofs of claim. Contrary to what a layperson might say, there is no financial test that is performed by the court at this time to determine whether the debtor is truly financially insolvent. And so this is really important. When I was first reading this chapter, so Chapter 11, bankruptcy, the business doesn't die. Like, it's not liquidated. That's Chapter 7. With Chapter 11, the management team feels that if they have a little bit of relief, a little bit of breathing room that the court system can provide for them, they can kind of reorganize the business and emerge from bankruptcy and perform better. And so that decision to really head in to file the petition for relief, there's no minimum, like there's no expected, you have to be losing X amount of dollars. If you file for it, that's it. There's no test. There's no financial test, which, is not good at times because maybe, the debtors make a wrong decision, right? Because the problem with going into Chapter 11 is the moment you go into bankruptcy, all equity holders lose the interest in the business, and the debt holders have claim on the business now and its assets, right? So really the debtors take control of the business, which really puts the previous equity holders at a disadvantage because they just get pushed out without really any tests to confirm whether they had to file for bankruptcy. But majority of the time, the management team knows, they're well aware that we just cannot pay this debt and we're going to go into bankruptcy, so we just file the petition for relief. So after the bankruptcy filing, the bankrupt company is referred to as the debtor in possession. This is a new legal entity. However, for all practical purposes, it usually is the same company with the same management and the same employees. From the creditor's point of view, this is one of the problems of the bankruptcy process. That is, the same management that led the company into its financial troubles usually is still running the business while a reorganization plan is being developed. When the petition is accepted by the court, an automatic stay is granted. This is one of the main benefits the debtor receives in the Chapter 11 process. During the automatic stay, a halt is placed on any pre-petition legal proceedings as well as the enforcement of any pre-filing judgment. So with automatic stay, essentially the moment the court deems, okay, yes, this you need to file for bankruptcy, we accept your petition for relief, we grant this automatic stay, which means that the debtors cannot claim assets. They can't really force you to sell your assets so that they're paid off. You have that breathing room, and this is really what the business wants. It wants this protection so that they have room to move and kind of reorganize themselves. Creditors are unable to pursue a lien on the debtor's assets or to collect money from the debtor. If the creditors can convince the court that the assets that are being used as collateral for obligations due are not necessary for the continued operation of the company, or the debtor has no equity interest in the assets, they may be able to get relief from the stay. So automatic stay prevents the debtors from being able to really access the assets, but through a lengthy process, if the creditors feel that the business has non-core operating assets that can be sold off to pay off the most senior of creditors, then they can negotiate with that with court, and if the court grants them the approval, then they can claim those assets. But what the automatic stay does is it prevents that, so that creditors are unable to pursue a lien on the debtor's assets. Now, within 10 days of filing the Chapter 11 bankruptcy petition, the petition for relief, the debtor is required to file a schedule of assets and liabilities with the court. This schedule must include the name and addresses of each creditor. The next important date is the bar date, which is the date when those creditors who have disputed or contingent claims must file a proof of claim. A proof of claim is a written statement that sets forth what is owed by the debtor to the particular creditor. Failure to file by the bar date results in forfeiture of the claim. So it's really important that the creditors are well aware. They'll be notified that the company has filed the petition for relief. The company will then, the debtor in possession, as they're referred to as the legal name, they will file a schedule of assets and liabilities, and then the court sets a bar date for 20 days away, and all the creditors have to come forth and submit their proof of claim to show what they are owed and show the legal documents supporting that claim. According to the New Generation research, over the period of 1982 to 2004, the average duration of a Chapter 11 filing was 16.4 months. I think that's really important to take away. So the average restructuring, the corporate restructuring period, takes about a year, less than a year and a half, 16 months. So that's quite lengthy, but at the same time, it's not that long, especially when you're thinking about the longer term view of the business. The Chapter 11 process allows for the use of the secured creditor's collateral by the debtor in possession. Creditors are barred from seizing assets while the automatic stay is in effect. This does not mean that the debtor has free use of the property. The debtor must make some accommodation to the creditors, such as periodic payments for continued use of the assets. The debtor may continue to operate the business during the reorganization process. The law requires that the debtor obtain the approval of the bankruptcy court before it takes any extraordinary action that is not part of the normal business operations, such as selling assets or property. And so that's really important. With the Chapter 11, the moment that the automatic stay is granted, during that on average 16-month period, the business still needs to be run. Operations aren't shut down. Management has to focus both on restructuring the business and focusing on really kind of settling the claims of creditors, but at the same time still running the business and focusing on getting out of this restructuring process. The debtor is usually granted significant leeway and will be opposed only when its proposed actions are clearly objectionable. There are, however, special committees where trustees will oversee the actions of management to ensure the interest of creditors is protected. So after the filing of the bankruptcy petition and the granting of the automatic stay, only the debtor has the right to file a reorganization plan, right? So the creditors can't push that. The debtor has to do that. This period, which is initially 120 days, is known as the exclusivity period. It is rare, however, especially in larger bankruptcies, to have the plan submitted during that time frame. It is common for the debtor to ask for one or more extensions. Extensions are only granted for cause. So this exclusivity period is this 120-day period where after the automatic stay is granted, the debtor has to now think, okay, how are we going to reorganize the business? And they have to put that on paper. It's kind of like a new business plan. They change up the business plan, and then they have to go back to the creditors and make them agree with it. They have to negotiate and say, okay, do you feel that you're comfortable with the new look of this business, this new strategic direction? And so the exclusivity period defines 120 days. Within 120 days, you have to submit it. Now, that's way too short. Bankruptcy lasts almost 16 months, right? So what usually happens is the debtor in possession is going to go back to the court and ask for several extensions, which are commonly granted. So one of the problems a near bankrupt company has is difficulty obtaining credit. If trade creditors are concerned that a company may become bankrupt, they may cut off all additional credit. To assist bankrupt companies in acquiring essential credit, the Code has given post-petition creditors an elevated priority in the bankruptcy process. That is, post-petition claims have an elevated priority over pre-petition claims. So essentially, one of the big problems is, say, for example, you're a retailer. With retailer, they need short-term access to funding to really kind of help them pay for their inventory and then sell off and then pay down that credit. Now, if the retailer goes into bankruptcy, well, creditors are going to be concerned that, hey, I'm not going to get paid back, right? You're right now restructuring your business. I don't want to lend money to you. And so to incentivize creditors to still offer them lines of credit and access to capital, the court system has allowed really the seniority of credit, so the post-petition credit, to be put over the pre-petition claims. So even if you have the most senior of creditors pre-petition, so pre-bankruptcy restructuring, those claims are going to be settled after the business settles the post-petition claims. So in worst case scenario, the creditor lends to that retail store, and the retail store just can't work it out and eventually has to liquidate. The first people to get it are the post-petition claims. Now, the reorganization plan, which is part of a larger document called the disclosure statement, looks like a prospectus. For larger bankruptcies, it is a long document that contains the plans for the turnaround of the company. The plan is submitted to all the creditors and equity holders committees. The plan is approved when each class of creditor and equity holder approves it. Approval is granted if 1/2 in number and 2/3 in dollar amount of a given class approve the plan. So this disclosure statement, which is that reorganization plan. So you have the exclusivity period, 120 days. Maybe it's granted, renewed another 2 times, right? So after 360 days, the debtor submits this disclosure statement. And so the 2 main groups are the equity and bond holders, the equity and credit holders, right? And so 1/2, so at least 50% of the holders themselves, and 2/3 in dollar value, so the market value, 2/3 of that have to agree with the new disclosure statement, or if not, it has to be continually renegotiated before the company can emerge from Chapter 11 bankruptcy. The plan will provide a new capital structure that it is hoped will be one that the company can adequately service. This will typically feature payment of less than the full amount that was due to the claim holders. So there was a famous bankruptcy of Penn Central Railroad back in the 80s, and the disclosure statement that was agreed upon, the claimants, the creditors, were paid the 100% value, 10% with cash, and the other 90% satisfied, 30% in each new mortgage bonds, preferred stock, and common stock. And so that's what happens. Majority of the time when you settle these claims, the company doesn't have the cash to pay those claims back in full. So usually they get paid back maybe 80 cents on the dollar, 70 cents on the dollar. And that paid back, maybe 10% or 30% at most is paid back in cash, whereas the remaining part, the business issues new equity. So now, and this is really when you talk about when a company goes into bankruptcy, the bondholders get claim of that business. The reason that is because the bondholders have senior claim on on the business's assets. So when they negotiate the disclosure statement, what happens is the bondholders receive equity in the new business. So the pre-petition equity holders lose everything because they lost, right? The company went into bankruptcy. And so the new company, the bondholders of the pre-petition company become the owners of the new company. And so that's really a very effective way of gaining control of a company. And then we'll talk about that later as well. So looking at the benefits of the Chapter 11 process, there are many. Like the first and probably the best one is that through Chapter 11, the company has an ability to restrain creditors from seizing the debtor's property. So that automatic stay creates that room, and it allows a business to continue to operate. It allows a business to borrow more money because through the court system, it provides that priority for post-petition creditors to lend money, and in the worst case scenario, they're the ones with the most senior claim on the business's assets. And it has many more benefits, but really, you should be focusing on Chapter 11, creating breathing room for the company to reorganize and move forward with a new strategic plan, different from when it entered the Chapter 11 process. Now, from a company size perspective, the fact that debtors enjoy unique benefits while operating under the protection of the bankruptcy process is clear. Smaller companies, however, may not enjoy the same benefits. Smaller companies were less likely to survive post-restructuring, and ownership was more diluted due to management and money challenges. So looking at this research in 1982, over 17,000 companies sought protection from creditors under Chapter 11. Now, from a revenue perspective, 41% of them range between 0 to 25 million, whereas over 100 million in revenue, only 7% of the businesses. So you can see that smaller companies are more likely to file for Chapter 11. Now, of these firms, 6,722 are still in business under the same ownership. Now, from a success rate perspective, now the most likely to fail are the small companies, and the least likely to succeed are the small companies. Only 30% of the companies between $0 to $25 million in revenue were able to succeed once they emerged from Chapter 11, whereas the companies exceeding 100 million, over 69% of them were able to succeed. Right? And so so again, like when you think about bankruptcy, like people think, oh, the business has failed, it's all over. Yes, for equity holders, you lose your money. But from the business's perspective, it's a way to restructure and emerge stronger. And again, from a percentage perspective, the larger companies are less likely to fail, but if they do fail, they're more likely to succeed once they emerge out of Chapter 11. Now, what about prepackaged bankruptcy? In a prepackaged bankruptcy, the firm negotiates the reorganization plan with its creditors before an actual Chapter 11 filing, so before the debtor files a petition of relief. In a prepackaged bankruptcy, the parties try to have the terms of the reorganization plan approved in advance. This is different from the typical Chapter 11 reorganization process, which may feature a time-consuming and expensive plan development and approval process in which the terms and conditions of the plan are agreed to only after a painstaking negotiation process. And of course, the benefit of this is time, right? So the average time is 16 months. But if you have a prepackaged bankruptcy, you can kind of speed through that restructuring process to really make sure that the business gets on its feet fast. Now, obviously, the main benefit is that both time and money are saved by agreeing to a restructuring plan before entering Chapter 11. The other advantage is dealing with the holdout problem before being restricted by the exclusivity period. The common way is to pay all the small creditors 100% of what they are owed and pay the remaining main creditors who hold a bulk of the debt an agreed upon lower amount. So essentially, one of the problems when you are in Chapter 11 and you're negotiating this disclosure document is that it's in the incentive for the smallest debt owners, the party that holds 0.11% of debt, to really hold out, to really make sure that they get 100% of their value. Because not only are they invested little, but because they are so small, you'd think that, they don't have a lot of say, but they do, because if they continue to really hold out until they get 100% of what they're owed, then the company can't move forward. So they really have a lot of leverage in the negotiation process. So when you are in bankruptcy, like during that restructuring process and during the exclusivity period, if you haven't negotiated with the small creditors, usually what happens is you have to pay the small creditors in full to really get them out of the way, while the bigger guys who really own a lot of the bulk, for them, they can kind of take a haircut because they're much larger. But with the smaller investors, they're looking for 100% of their money back, right? With prepackaged bankruptcy, though, you're not forced. From a time perspective, there's no exclusivity period. It's coming, but it's not there yet. And so you have the option to really take your time and sit down with the creditors and maybe not pay them 100%, maybe pay them 90%, so 90 cents on the dollar, right? And so there's much more flexibility when it comes to prepackaged bankruptcy. Now, a workout refers to a negotiated agreement between the debtors and their creditors outside the bankruptcy process. The debtor may try to extend the payment terms, which is called an extension, or convince creditors to agree to accept a lesser amount that they are owed, which is called composition. A workout differs from a prepackaged bankruptcy in that in a workout, the debtor either has already violated the terms of the debt agreement or is about to. So really the difference between prepackaged bankruptcy and workout is with prepackaged, the company is going to file a petition of relief. They haven't, but they will, and they've already negotiated and agreed upon a disclosure document. Whereas with a workout, they're trying to avoid entering that. So they never do. At the end of the day, they just work it out and try to settle on, again, extensions and compositions. And the main benefits of workouts are cost savings and flexibility. Workout agreements generally cost less to both the debtor and the creditors in terms of the resources the participants need to devote to the agreement process. In addition, participants in a workout are not burdened by the rules and regulations of Chapter 11 of the Bankruptcy Code. They are free to create their own rules as long as the parties agree to them. They also avoid the public scrutiny that comes with when a company does file for bankruptcy and the media covers, like JCPenney has entered bankruptcy. Oh my God, it's the end of the world, right? So really, there are some benefits. Now, of course, there are some downsides. Now, from a tax perspective, if a company enters into a voluntary negotiated agreement with debt holders, whereby debt holders exchange their debt for equity and the original equity holders now own less than 50% of the company may lose its right to claim net operating losses in its tax filings, which is a huge loss because you want to get those NOLs. So in the future, when you do start reporting, the profit, you kind of want to defer those tax payments by using your net operating losses, right? So the forfeiture of these tax loss carry forwards may have adverse future cash flow consequences. So that's why prepackaged bankruptcies are considered, in my opinion, much better than workouts. In bankruptcy, however, if the court rules that the firm was insolvent as defined by a negative net asset value, the right to claim loss carry forwards may be preserved. Also, if a debtor company reaches a voluntary agreement whereby creditors agree to cancel a certain percentage of the debt, say 1/3, this amount is treated as income for tax purposes, thus creating a tax liability. A similar debt restructuring in bankruptcy, however, does not create such a tax liability. So with workouts, if the debtors agree to receive only 50 cents on the dollar, that write-down in debt is considered income for the business, which really puts a lot of pressure, and then all of a sudden, the company has to report even worse earnings than before. Whereas if you go into prepackaged bankruptcy, you agree to a disclosure agreement where there is composition, where you do agree to a lesser cents on the dollar, but that's not reported as income because you're in Chapter 11. You're protected from using the legal system. Now, what are the costs of voluntary restructuring? So researchers have found that firms that attempt voluntary restructuring, these workouts, outside Chapter 11 were less able to reduce their leverage compared with Chapter 11 firms. They trace the problem to higher transaction costs of voluntary restructuring. Examples of these costs include the credit holdout problem, which makes it difficult to get all creditors to participate in the agreement. This problem is greater for holders of smaller claims who have an incentive to hold up transactions until they receive preferential treatment. And so when you look at workouts, with workouts, you have to once again agree with all the parties that are in the room, right? But the court system is not looking out for the business. As long as you agree on the terms of whatever agreement you're going to make, then that's okay. But that agreement is usually driven by the creditors. So the creditors really want to make that workout happen, whereas the debtor, he doesn't have a lot of negotiating power. So prepackaged bankruptcy, or just going into the bankruptcy process, increases the amount of negotiating leverage for the debtor. Now let's talk about Chapter 7, liquidation. So liquidation is a distressed firm's most drastic alternative, and it is usually pursued only when voluntary agreement and reorganization cannot be successfully implemented. In a liquidation, the company's assets are sold and the proceeds are used to satisfy claims. Priority of these claims are as follows. First, the senior creditors receive money back, then the bankruptcy administrative costs, the legal fees, the investment banking fees, then the wages of the workers and employee benefit contributions, then federal, state, local taxes. Following are pension liabilities and unsecured claims, then preferred common stockholders, and then common stockholders. So when you think about really just from a rate of return, that's why common stockholders have such a high expected rate of return. That's why the cost of equity is so high, because they're the lowest on really the claimant list. So in a liquidation process, all of these guys have to be paid first before common stockholders receive their money back. And majority of the time they don't. They just lose the money that they invested in those shares. Now, investing in the securities of distressed companies may offer great profit potential, but only if the buyer is willing to assume significant risks. Distressed securities are defined as the bonds or stocks of companies that have defaulted on their debt obligations or have filed for Chapter 11. Buyers of distressed securities, or are called vultures, may actually be seeking to obtain an equity stake in the distressed company when they purchase the debt securities. This has helped fuel the market for claims trading. And a very famous investor who has done this is Carl Icahn. Multiple times throughout the 1980s and 1990s, he's bought bonds that were trading for 5, 6, maybe 10 cents on the dollar, and just waited for the company to enter bankruptcy. The moment the company entered bankruptcy, all of a sudden they had to negotiate that disclosure document. And so what happened is that Icahn would then say, okay, I want to take equity as compensation for what I need to receive from the business. And so the business would give him large stakes in equity, and all of a sudden, once the business emerged out of Chapter 11, or all of a sudden he owned 30% of the company, even though from a purely dollar perspective, he invested much less. And so this is a great way to really acquire companies. Of course, you do need a high risk tolerance though. Now, contrary to the reputation that these vulture investors have, research has found that they have a positive effect on the post-debt operating performance. They found that post-restructuring operating performance was improved relative to the pre-default level when the vulture investor becomes CEO or in some way gains control of the company. They attribute this improved performance to enhanced managerial discipline because the management team are fearful now. They have this activist investor who owns a large portion of the company and who really can say whether they still have a job or don't. And so there's a lot more discipline when it comes to having this activist investor hold a large stake. And really that's the whole argument with activist investing. If you're an activist investor, you come into the company and you have a voice which can really kind of increase the discipline for management. And so research has supported that statement. Now, just covering the key definitions that we talked about in the video, we had the reorganization plan that is proposed by the debtor, with the petition for relief, which is filed initially once they enter the Chapter 11 bankruptcy process. There's the proofs of claim, which the creditors have to show this is what I'm owed by the business, by the debtor. The debtor in possession is a legal term referred to the new legal entity of the debtor. They're now the debtor in possession during the bankruptcy process. The automatic stay is the legal is granted, which provides room for the business so that creditors cannot claim assets. They cannot take those assets and sell them right away. They're protected by the court system as long as the automatic stay is still granted. There's a schedule of assets and liabilities, which lists out what the business has and what the business owes. And the exclusivity period is the 120 days in which the business, the debtor in possession, has to file a reorganization plan, which is agreed upon by the creditors and the equity holders. And that agreement needs to be at least half, 50% of the people, and at least 2/3 in dollar value. And so that's what we talked about in the previous slides. Other than that, that's pretty much it for this video. I really enjoy learning about this. I feel like I might do some more distressed debt M&A kind of stuff. So check out those videos in the future, but I do have a lot of investment banking videos of some interviews, DCF modeling, other valuation methodologies that I do, IPOs, M&A, economics, environmental economics, financial planning. There's tons of stuff on my channel, so I do recommend that you check out my channel and subscribe to the channel as well. If you have any questions, please do comment below, and I'll be sure to get back to you as soon as possible. Thank you guys, and have a great day.